Good. Thank you for that introduction, Ole Christian, and welcome to everyone for an update on SKAGEn Global and a few words about the market. And like Ole Christian said, these are certainly interesting times to say the least. Now, the agenda for today, we want to go through three different things. First, share with you some market observations, what we're seeing, some interesting, in our view, statistics, and just to sort of give maybe a summary of some of the key variables out there to kind of help form some type of helicopter view of kind of what has happened over the past period. Then we'll go into the portfolio, have a look at what it looks like currently, and share with you some thoughts on that aspect. And then third, the outlook here, which is again a mix of parameters to consider as we look forward here and think about how to position the funds and kind of where to maybe look for some ideas. With that, we're going to go into the first section here about the market observation, and this graph kind of shows you a long-term history of the VIX index, and some of you may know the VIX index. It is also known as the FEAR index, or in Scandinavian the SKAGEn index, basically showing you what the kind of expected future volatility is going to be. And the attribute here is that the higher the VIX index is, the more the market is shaking. Essentially, very high number here means that the market is going down. Now, looking at this, earlier this year we had a peak in the VIX index at 82, so beyond what this graph is showing here, which was actually higher than the level the VIX reached at the time of the financial crisis. So it tells you something about the magnitude of the uncertainty, of the volatility that you've seen in the market. Many of you have probably kind of read about the big market move a couple of weeks ago, when you had the biggest move since 1933, so biggest move in 8 to 7 years. And then interestingly, in the following days, you had also the biggest up move in about 90 years. So it's been some sort of crazy moves in the market here, but sort of a good way to put things in perspective. And we think it's also easy to think about this as part of what's driving this, and based on what we've heard in our discussions with the trading desks of some of the biggest investment banks, there's been a massive amount of ETFs and passive funds, basically blanket selling, which of course explains some of those huge moves we've seen. I mean, think about a company like JP Morgan, which has a market cap close to $300 billion, and that share has been, the sign point was up 18%, or Home Depot that we own in the fund, market cap around $200 billion. That stock was at some point up 20% on a day, which is essentially unheard of. So there's been this just enormous selling pressure, largely from index funds, and it's been, in many times it seems like it's been amplified by different momentum strategies, risk parity trades that have essentially led to more kind of forced selling. If we move on and look at the markets and try to kind of just get a sense for what have different markets done around the world, that can be hard to keep track of, and just to be clear, I mean, these things obviously change in a short period of time. So this is sort of a snapshot where we were as of last night. Maybe one thing to look at in this picture is just a big spread from Brazil come down here, having been essentially down around 40% year to date, measured in Norwegian krona, to in the other end of the spectrum, China has held up well, very well actually, compared to other places. So kind of interesting to sort of see where things are. And we have MSCI, all countries, world index, down around 6% kind of so far this year. SKAGEn Global a little bit ahead of index here, but again, kind of big spread. And here we have the Nordic indices, Oslo Börs -25, Stockholm and Copenhagen kind of doing the best. If we then move on and we kind of take a look at the next layer, maybe on a sector level, kind of what has the performance been like in the MSCI World Index, going from kind of left to right, we see kind of from best to worst, with probably, as you would expect, healthcare being very defensive, IT probably being a bit more defensive than people had expected. I mean, there was a lot of chatter over the past couple of years about some of the IT names being expensive. For example, the FANG names, the Facebooks, the Amazons, Netflix, and so forth. But actually, so far, they have held up and outperformed the market, which is sort of an interesting observation. Utility staples, I guess, as you would expect, they have been defensive as well. And then on the negative side, the more economically kind of sensitive indices or sectors, materials, finance, and of course energy are taking a disproportionate hit, down 35% so far. If we go down even one more level and kind of look at the on the individual names in the global index, from the top 6 and the bottom 6. Again, the trend is first the same, that you had a huge dispersion in performance from more than 100% up to 70 or actually 90% down in some cases. And maybe just for fun, if we look at the top 6 ones, if I show you the logos, I don't think you're going to recognize too many of these logo types. But if you think back to which country had done the best, it was China. And that will explain why many of these names come from China, and they are names kind of in the medical technology, agriculture space. One maybe particular interesting one is this one, Wuhan Guide Infrared, with the name Wuhan, of course, drawing some special attention. But this is a company making diagnostics equipment that can be used, infrared diagnostics that can be used, for example, for medical examinations and testing. And I guess it goes without saying why that stock has perhaps done well so far. Now on the bottom 6, again reflecting essentially what we've seen in the indices, with the energy sector being a big negative. I mean, all of these 5 companies here are essentially energy-related companies in one way or the other. And then Norwegian Cruise Line being the other one, kind of bottom 6 in the universe. Clearly, the cruise industry has taken quite a hit so far. So that's a bit kind of where we stand in terms of markets, sectors, some of the names so far. Other things that come up sometimes is, what about gold? Even though gold doesn't really feature in our fund, from a market perspective, it can be worth having a look at it and see how it has performed. And this goes back all the way to 1920 and kind of shows you the gold price. And so far this year, gold has been a decent performer. But it's worth noting, and this is not easy to see from this graph, but during the panic episode over the past few weeks, gold did actually not hold up all that well. And the rumor on the street is that there were people who were forced to sell gold to cover some other type of margin calls and so forth. And in fact, it seems like the US dollar was sort of the safest haven during those times. So that's kind of one thing. Another one, again, maybe this one more for entertainment here, but Bitcoin has been something that has been discussed lively here, and there's been a big debate whether it's going to be defensive or not when things actually sell down. And with this type of market sell-off, you get a good chance to test a lot of the hypotheses that are being debated in the market when things are going well. And what we can see in terms of Bitcoin is that during the panic episode, kind of from the peak here, February 19th, down to the middle of March, it was actually a pretty bad performer, down 53%. But year to date is faring a little bit better, so this is maybe kind of 12% down on a year to date basis. So maybe some ammunition here, both for the bulls and the bears when it comes to Bitcoin. But just to be clear, does not feature in our fund, but it's maybe part of the more market observations. Then interest rates. Something that we think is again interesting to look at from the longer term view, and this has of course been also part of the debate for a long time. This is the graph with the longest track record that we have ever seen. It supposedly goes back all the way to 3000 BC, which is a time when you had the first dynasty rule in Egypt and the time when Stonehenge was being constructed in the UK. So it has sort of a long history to look at here, but clearly kind of looking at the more recent times, we've seen the trend continue here, and kind of the race towards zero seems to be intensifying. If we look at the bond yields, I mean, this is now for some of the different biggest economies in the world, and kind of going back to a few decades. Clearly here, kind of US in the blue line, now down to about 60, 70 bips, so 0.6, 0.7%, kind of continues to climb down. And it's interesting to kind of think back just a few months when you actually had the US 10-year being, up here sort of above 2%. So that quick or rapid sell-off or fall has obviously been unanticipated. Still, a couple of economies going to have a little bit better. Kind of India, sort of around 6%, and China here in red, 2.5%. So there are some places in the world where you can still get some yield, but let's see for how long. Next, looking at the pricing of the different markets. This is a graph showing you the forward PE on the y-axis, and then you have the earnings growth on the x-axis, the expected earnings growth over the next year. And it will show you sort of that the correlation sort of between earnings growth and PE, doesn't really seem to be all that strong. These dots are sort of all over the place, and kind of here you have the MSCI World sort of being in the middle of around 13 times and 6% earnings growth sort of on the most recent estimates. US, of course, still more expensive, as you probably would expect. Japan, lower. Europe, lower. And select European countries even below that. Now, again, we like to kind of look at the longer trends. So if we take a look here at the pricing of the MSCI All Countries World Index. This is on the forward PEs, and we see that we're kind of currently here just around 12.9 or just around 13 times. Okay, so this goes back about 10 years, and the green lines, they show you one standard deviation above and below the median. Okay, the median is the dotted blue line here, which is showing you 13.2. So I guess for most intents and purposes, we are essentially in line with the 10-year median. We would say that we're kind of down to what looks like fairly attractive levels if you think that the economy at some point in the not too distant future will recover, so that you can have some trust in the earnings figure. As we've said sort of sometimes in the past, that we at SKAGEn Global, we kind of prefer though to look at a at a free cash flow metric rather than a PE metric. The reason being that the PE metric is more easier to manipulate or distort through the kind of the earnings figures, and that's why we also like to look at the market pricing on a free cash flow basis. And here's one graph showing you the free cash flow yield of the again, the global index, the world index. And keep in mind that when we talk about free cash flow yield, the higher the yield is, the cheaper the valuation is. Okay, so it's sort of an inverse relationship from that point of view. You can see on this graph here, kind of with the orange arrows, kind of showing you that type of relationship. And this, of course, it was most extreme over the past 25 years when we had the financial crisis, kind of being around 16% free cash flow yield, whereas before the financial crisis, at the peak, when market was at the peak level, it was down to around 2%. So with that, kind of where we are today, here again, 25-year average, about 4.7. Currently, we're at around 5.7. So again, looks fairly attractive compared to the long-term history. But of course, I mean, looking at this graph, there have been several cases several times when we have had a more cheaper market. So there's of course still downside based on kind of the historical numbers. That was sort of everything we wanted to sort of touch on that section here, and we're happy to take any other questions on this side when we come to the Q&A session at the end of the presentation. I don't know, these are things that we keep in mind because it helps informs us, but as we have, and as you will know, we look at the companies and we are less concerned with trying to forecast on a macro level what's going to happen. But of course, you need to understand the context, the environment in which the companies are operating. And moving on to the portfolio, and this is the status, kind of the dashboard of the fund as of the end of February. And kind of looking at the ratings, number of holdings in the fund, concentration has stayed high. Upside is actually even higher now compared to then. I mean, back then we had 39, and now when I just looked at, we have more than 50% upside in the fund on a 2 to 3 year view forward. Now, and then what about the portfolio can we talk about? Well, I mean, we just want to again reiterate and hammer home the message that we continue to follow this sort of strict framework that we have talked about in the past, and even though there's sort of like crisis going on now, we're not going to deviate from the framework, but we will of course apply it to see where we can find attractive candidates for the fund. If we look at performance, this is a fund performance again as of last night, and just to be clear that things change quickly in today's market, so I wouldn't pay too much attention to the short-term performance. It can go up, it can go down, but obviously, we try to aim for an attractive long-term performance ahead of our benchmark. You see here the fund in blue and our benchmark in green. Again, this is just a snapshot from where we were as of last night. And this is from the homepage, same data in a different format. You can look at it every, it's updated every day. What has driven performance year to date? So this is again sort of preliminary figures from Bloomberg to kind of show you directionally what is the attribution analysis show. This is a standard breakdown between allocation in blue, selection in green, and currency in dark blue or black. And for the fund as a whole, if we look at on the right hand side, year to date, we've had the green section being the selection or stock picking, being the main source of alpha. So the outperformance has come from stock picking, which is obviously what we like to see. We have had a negative impact from the allocation effect, and that is primarily due to the fact that we have been slightly underweight in pharma, in consumer staples, for example. And then we've had a bit of a touch of positive alpha from the currency, but as we say, currency is a bit of a coin flip. It can go up, it can go down. We're not managing the fund based on what the currency is. Looking at the sectors, of course, you've had financials being the biggest positive contributor, which makes sense also because we have a significant exposure in the financials sector. Industrials, as you can see, also have a good impact from the stock selection. A little bit more challenging in consumer staples and in communication services as of now. But again, this can change for the better or for worse in a short period of time. To give you a flavor of the names that have done well, if we look at the, again, relative performance, so far can be different when markets close today, given the big swings. But again, where we are, we've seen ICE do very well. ICE is one of the biggest positions in the fund. It is an exchange operator, the company that owns and operates the New York Stock Exchange with a very strong, well-aligned management team, and we think that the fundamentals here look very good for ICE. So it's a big position. It has also been a good contributor year to date. Moody's, the credit rating agency, again, well positioned. It has held up well, and we think that the long-term prospects continue to be rosy or quite positive for Moody's. And then the last one, which may not be familiar to everyone, is Old Dominion Freight Lines. Old Dominion Freight Lines is a US-based LTL carrier. What does LTL mean? It means less than truckload. So it's basically a freight company which transports smaller packages or smaller pieces of packages here to different customers. Family owned, thinking very long term, good expansion opportunities, has the by far best service levels in the industry. It's not the cheapest company to employ if you want to buy some freight services, but it gives you superior service, and we think that they are, again, continue to be well positioned from here onwards. Then if we look on the negative side, we've had some smaller, and these are not big negative impacts here, but we've had a bit of headwinds for Bakkafrost, the salmon producer on the Faroe Islands, Tyson, the meat producer, and the ordinary share of Samsung has also been a small lagger so far. Again, these two kind of, and on the consumer staples side, we don't think there's been any real change in the long-term investment case. There's been some impacts just in terms of the pricing on the fish, on the meat, but they also sort of came off some pretty good runs over the past year. I mean, Tyson was one of the best performers in 2019. Bakkafrost did also very well here, so there could be a bit of a timing effect that they had a bit more room to fall than maybe some of the other holdings in the portfolio when you look at them on a short-term basis. This is just quickly summarizing, and this goes back to December. We don't have an updated one here, but it's showing you the ranking of the fund just compared to our competition with the excess return by quartile, where this is the bottom quartile, this is the top quartile, and we you can see on different time frames how the fund in blue ranks, and we want to keep this up here and keep sort of an attractive long-term track record. Then looking at the fund, and again, this is end of February. we haven't published. I mean, haven't closed out the next month yet, even though we're close. But we don't think it's going to look dramatically different, or it is not going to look dramatically different kind of once we come to the end of March. So directionally, it's still a good guide. Continuously going to show you that we have and just going to comment again on a few things. We're an active manager. We don't have to be in every sector. We don't try to hedge every single sector. We look at individual companies, and then the sector composition turns out to be what it is. End of February, we had nothing in energy. We had nothing in material. We had nothing in real estate. So we were completely naked, those three sectors. However, we did have an overweight in financials, and just to remind you again that we think that this exposure is actually not only in financials. Yeah, it's not 36% that is in banks or life insurance. In fact, we have a big part, maybe about half of this exposure being in companies that we think are miscategorized in the index. Like the exchange operators, some of the professional services companies that we own in the fund, they are classified by MSCI as financials, but they should probably be in technology or in business services. So if you take those out, the financials overweight isn't quite as big as you would otherwise think. And again, this goes back to our thinking that we're not too concerned what the index thinks, kind of what the label is from a third party. We look at the companies on an individual basis, and if we think there's a good long-term risk reward and the company is undervalued, then we're gonna put it in the fund. The top 10 list, again, end of February, showing you some of the key figures, how we compare kind of on a top 10 basis. And the whole portfolio, and then you have the index on the bottom row. And as we've said before, kind of some of these things that we've highlighted that we think are important to think about, to have a competitive advantage, to have a strong balance sheet, to be undervalued. And we think that when you compare the fund to the index, that we show that these are still there. You have index, for example, on a balance sheet point of view, being significantly more levered than our companies are on average. We have better net debt to EBITDA, we have better interest rate coverage, kind of to highlight that we do pay a lot of attention to the balance sheets. And likewise, when we look at it from a profitability point of view, whether it's operating margin or ROE, we tend to have companies that have highly profitable products that are difficult to replicate and that earn a lot of cash to the owners. Another view of the fund. Some of you have seen this one before, just trying to give a different perspective on what we own in the fund, some of the different categories, whether they be on the global consumer side, like Nike, Tyson, or LVMH, or sort of companies with very good operational skills that are undervalued by the market, DSV in Denmark, Home Depot in the US, MasterCard that has global operations. So shows you kind of some of the other names that we currently have in the fund, or at least at the end of February. Now, we sometimes get the question here, like now during the big downturn here, I mean, what can you do? How are you doing now to kind of change the portfolio? And then we take the view and we say that sort of you don't really think about fixing the ship during the storm. You sort of need to think about many of these things ahead of time before the storm sort of happens. And we don't think that this ship is not meant to represent the fund in any way, but we have been clear when we have talked about what the fund looks at from an illustrative point of view in the past by showing you these two circles, where you think of stocks that will do well in a bull market in green, and the stocks that will do well in a bear market in blue. And we've said that SKAGEn Global looks at finding the stocks that can at least have a core in a portfolio of stocks that can do well in a kind of wide variety of macro scenarios. That's sort of the shaded area that you see here. And then we've said we can have some stocks from these different sides, and that continued to be the case. Now, one thing I wanted to mention here is the fact that when we have shown this slide for several years, we have always had the footnote down here showing you that what outperforms in a bear market actually varies usually based on what is the reason for the bear market. So in other words, when the financial crisis hit and you had a big bear market, doesn't necessarily mean that the stocks that held up well at that time will automatically be defensive also this time around, because now you have a different underlying reason for the bear market. So point here being that this is something to keep in mind, and we've tried to anticipate many scenarios before kind of going into this bear market. But of course, we also always kind of think about how we can improve the portfolio, how we can optimize it. And even though it has held up fairly well so far, there's always improvements that can be made. And without going into the specifics, what we have changed so far, given that the month hasn't closed yet, I can say that we have picked up a couple of names or so, and otherwise we have made some what we call essentially surgical changes, meaning that when there has been some extreme movement in a stock, or then we have gone in and we have perhaps added or taken a few chips off the table in order to again continuously look forward, think about how is the portfolio going to look or perform when we look out, because I think currently we're still in a phase where a lot of the market is sort of talking about what is defensive, what's going to hold up if this virus drags on for a longer time. But at some point you're going to get to a stage when there will be a flip, and it will more be talking about what's going to recover most quickly. And for us, thinking about those two circles and how they're interacting, we want to have a portfolio that can also keep up with the market when it goes up to some extent, to largest possible extent, without having to flip the whole portfolio. So we're not in here to make a huge amount of changes, but it's more about kind of doing something incremental and keeping a close eye on if there was kind of warrants a switch between what we own and what's on our watch list. Just sort of philosophically, the way we think about running the fund, the portfolio, even in this down market, is that we essentially want the best team to play. And what we mean by the best team is the team, the players, the stocks that have the best long-term risk reward. Okay, and as long as the investment cases are intact, as long as the management teams execute as we expect them to, then we tend to be patient long-term shareholders. Everybody can have a bad day. It can be kind of a bad quarter. That doesn't change things here. But of course, if something continues to not perform as we expect, then we're going to be ruthless when it comes to changing. There are no sacred cows in the fund here, and there could be some changes, of course, over the next few weeks and months. One thing that we've kind of been getting some questions on has been about the exposure in the fund to small cap versus large cap names. You might know that we have a significant majority of the companies being sort of large cap companies in the fund, and one reason that we have pointed to is the fact that many of the small caps have built up a lot of high leverage over the past few years. And if you look at this graph, it goes back all the way to 91, and it shows you the S&P 500, and then it shows you the American Russell 2000 index, which is essentially a small cap index. And here you can kind of see the net debt to EBITDA levels, which have been rising rapidly for the small cap, not as much for the large cap. So that is something that we have stayed away from. And it has also helped us during this downturn, because we've noticed that companies that have had a lot of debt on the balance sheet, they have been hit pretty hard. So sort of now it's been sort of a good time for companies that have been a bit more conservative in how they have been operated, how they have been run, and they're getting some payback from that at this point. Also got to say a couple of words about the oil price collapse. Oil kind of down around 65% year to date. The graph here shows you the Brent price dollars per barrel, kind of all the way back to 1988, and then kind of how it's done so far this year. And as you saw when we looked at the sectors, and as we've been talking about in the past, that raw materials, I mean, those companies tend to have limited ability to really affect their own future. I mean, they are essentially price takers based on what's happening with the commodity price. And we haven't had any energy exposure in the fund, because we think that when the oil price is sort of around $50-60 per barrel, then the risk reward isn't necessarily favorable. Oil price, it can go up some, it can go down some. So being in those companies, in the energy company at that level, didn't make sense to us. We also said clearly that we have an unconstrained mandate, and if you would see sort of a big pullback, then it would make it more favorable to look at the oil companies. And we note that sort of given the big pullback here to date, that have made those companies, in our view, more attractive given the steep kind of valuation sell-off. And in fact, if you look at the energy stocks versus the S&P 500, this is kind of showing the relative price performance going back, all the time to 1926. Okay, so back to almost 100 years. Today we're kind of trading, almost 2 standard deviations below the mean here, and clearly there has been quite a traumatic sell-off in the energy stocks that may have opened up some opportunities. But just the last point comes to show here about the portfolio, the last comment, that we continue to look at places where we have had attractive kind of long-term outlooks. These tend to be the areas that we have talked about in the past, and we continue to think that all of these are still good hunting grounds for long-term investors. Okay, then quickly a few comments just about the outlook and the debt picture. This is, of course, going to give you a bit of a summary of kind of what things are standing now with the big government programs being launched. This one shows you left federal debt as percent of GDP back more than 200 years. On the right-hand side, we have the Fed, the balance sheet history, and what's expected to happen with the current programs. Obviously, a big step up in the debt levels for the governments, not only in the US, also in Europe, with the ECB balance sheet there, as you can see on the right-hand side, taking a big step up. There's, of course, a debate going on, and it's going to probably intensify, whether this is going to take us closer to some type of inflation or maybe even hyperinflation scenario, or if we're still closer to the deflation scenario. We don't have a strong view on this one. We don't try to, again, anticipate or forecast these macro variables here, but if anything, we don't think that if we had to sort of say something with a gun to our head, we don't think that these programs will be sufficient to somehow tip the scale and lead to a hyperinflation scenario. We don't think we're there yet, but we're, of course, kind of one step closer. Sentiment in the market, just to kind of show you, I want to show you a couple of graphs from the Bank of America, the Global Fund Manager Survey, comes out every month, and it looks at a few hundred, 200-300 fund managers, how they think about the world, what they do, what their expectations are. This graph kind of goes back to 2001 and shows you the change on a month-to-month basis in terms of the equity allocation. And it shows that last month here we had the biggest monthly decrease in equity allocation since 2001. So of course a dramatic move down in sentiment among the fund managers around the globe. And the next slide here kind of shows what the fund managers, so not us, but the kind of the collective fund managers, what they think about the biggest tail risk in the market. The light blue here kind of shows you what the tail risk was in February, and then we had the US elections being the biggest tail risk, but it has clearly been overtaken, as you would expect, by the coronavirus here for March. It'll be interesting to see what it's going to say for April if the coronavirus kind of begins to fade in importance. So it'll be a kind of interesting barometer to keep an eye on. Now, I also just wanted to, when we talk about the outlook, to address the geographical allocation in the fund, because we get questions on that sometimes. And as we've said many times, we look at not so much where the company is listed, but more kind of where the sales of the companies happen in the world. And currently, as a kind of rule of thumb, or kind of a rough estimate, we have a little bit more than 50%, 50, a little bit more than 50 of the sales happening in the US, and the rest split fairly evenly between Europe and Asia and rest of the world. So Europe and Asia kind of being, and rest of the world being essentially two portions that are roughly the same allocation. And when we look forward, I mean, we continue to again focus at the companies and just to address sort of the emerging market pricing compared to developed markets. As you can see on this graph, the pricing looks essentially similar to where it has been over the past few years. Not exactly the same, but we haven't seen a dramatic shift in the pricing that would make us more positive or negative on the markets outside of the developed world. But we know that there's been kind of a few things happening that haven't maybe gotten a lot of attention in the press, and I think these are kind of things that the one should keep in mind, because they can escalate and they obviously happen for a reason. And I picked up a few examples here we've talked about in the past about how we have stayed away from Turkey. We have essentially stayed away from Argentina, as we've found that they've had unattractive fundamentals and political environments. And there's been a few other things sort of happening in the past few weeks. For example, Lebanon, they defaulted on the sovereign debt here in early March. It was actually the first time ever that happened. So clearly sort of big challenges in that part of the world. Moving to South America, Ecuador, same thing. They're just kind of at the brink here, or on the brink of defaulting on their sovereign debt. And why is that? Well, Ecuador is part of the OPEC alliance. It is the smallest member of the OPEC alliance. They need to have an oil price around $50 to balance a budget, and with oil price being in the 20s, that causes a lot of problems for them. So pretty challenging in Ecuador and in many other parts of South America, to be clear. And then a few days ago, I think it was last week, we had Moody's being the next and the final rating agency to downgrade the status to junk status. So that's also clearly putting that part of the world in a little bit less attractive territory from our point of view. But I also want to be clear that this can of course be an opportunity as well, if, and that's a big if, but if the political environment changes, if the companies if the countries decide to implement some big changes in the fiscal and sometimes monetary policies, then this can be sort of a huge opportunity if you will have to have a recovery. But we're not seeing that yet in any of the countries, at least not from our point of view. And then maybe just sort of final slides here about the recovery aspects in China. You may be seeing two different types of signs, different statistics. Is China coming back from the crisis, from the virus? We took out a few statistics, kind of looking first at the daily coal consumption, which kind of shows in the red line that is coming back here to approaching normal levels. They're apparently around 90%. So the industry looks like it's sort of picking up in China. If we look at traffic, it's not as congested as before, meaning that haven't quite gotten back to the previous level, so still more slack in the system on that point of view. And the final data point from Nike. Nike is part of the SKAGEn Global portfolio. They reported last week and they said that they had previously had about 75% of the stores closed, but as of now they have 80% of the stores open. So looking to coming back to normal here in a short period of time. And that of course brings us maybe to the key question that many might be thinking about, where is the market heading? If the market is this yellow dot and that can go from here, what is the next path that it's going to follow? Is it the green or is it the red arrow? And here we can just say that we always say we don't try to make any predictions about the market. It can go up, it can go down. We think in the long run it's gonna go up and recover, as it has done in many previous crises. But exactly if we're at the bottom now or if it's going to take another leg down, who knows? It is sort of beyond our ability to make that forecast. So to wrap up, and just the final slide here is that we continue to follow what we call the SKAGEn Global philosophy with the Robinson Crusoe style investing, meaning that when you think about if you were to be sent to a deserted island, you had to be there for many years. You weren't sure, you had no idea of knowing how the global economy was going to perform, and you still wanted to own companies that you thought were best positioned and most attractively valued to outperform the market during that time. What would you put in your portfolio and kind of take with you to the deserted island? That's what we try to look for, and we'll kind of continue to follow that philosophy with religious discipline. That's everything on the presentation, and I'll kind of turn it back to Ole Christian for the next part.
Thank you very much, Knut. That's really interesting. We have a few more minutes, so if you have any questions, do prepare them as I pose one of the questions that has been sent to us in advance. Did SKAGEn Global manage to go cash as the market went down? That's one question.
Yeah, so a quick answer, since we had a chance to look at this one in advance. We did not go cash, so we did not try to raise a lot of cash before the market went down, because again, we don't try to time the market, meaning that we don't try to have a big cash pile in the fund. We leave it up to the fund's investors to think about how they want to allocate their capital between cash and equity and so forth, and everything that goes into the fund. We try to give the maximum equity exposure at all times, and keep a cash level ideally below 2%, and oftentimes even below that. And in the past few weeks, or for most of this year, we have been below 1% cash. which of course is a bit negative when the market goes down, but when the market goes up, then you recover those losses, and over time, which is the critical part in the long term, you benefit since you don't have a big cash drag in the portfolio.
Okay.